Hello and welcome to this very special show, the Morgan Stanley View, and we do it 3 or 4 times a year, wherein we get two brilliant brains, Amay Hattangadi Swanand Kelkar, to talk about how are they mapping the market mood currently, both global and local, and what would their investment approach be in the current scenario. Thanks so much for joining in once again. Always a pleasure having you. Amay, let's start off with you. The last few days, it seems to be a bit of a risk-off mode, if you will, until 2 or 3 key global events shape out. Maybe the Fed meet, maybe the Brexit vote. Is that a correct assessment? Do you think over the course of the next 30, 35 days, 40 days, there could be a bit of a significant risk-off that could happen globally?
Well, I think right from the beginning of this year, or for that matter, even starting August last year, we've alternated between these phases of risk-on and risk-off. Most of the fears in the past have been around the Chinese markets. If you recall, we started the first trading day in January in China with stock markets down, almost limit down or something of that sort, right? So I think this we have to accept as something which is going to keep recurring. We are at any point of time going to be obsessed about some event or the other. January it was all about China. Now, as you're saying, it is about Brexit. It's about Fed rate hikes. So I think this is here to stay. These kind of worries from time to time, and I think we will keep alternating between risk on and risk off. And I think our mantra is to remain focused on our core job of investing while being mindful of these big events.
Yeah. No, the reason I'm trying to probe this a bit further, Swanand, is that so you had notable names like George Soros, for example, 3 or 4 days ago came out and said that he's got the highest underweight position on the US equities in a really long time, 37% cash. I mean, there were a number of statistics thrown. And if there is a significant downturn, if it comes about in the global markets, it will have a telling impact on our markets too.
Yeah? Sure. I mean, there's no escaping that. I mean, that's what we...
So how likely is that?
That's what we've always told you, that, I mean, India won't be decoupled from a global scare, and we've seen that in the past as well. So as you mentioned, there are 2 events on the horizon that everybody on the macro side is watching. One is what happens on the Brexit side, and the June meeting of the Fed is extremely important. The key debate in my mind, especially about the US Fed, is does the US Fed consider only the economic conditions in the US and its so-called dual mandate of employment and inflation as the only considerations in setting monetary policy? If I were somebody who does not have too much of an understanding of global macro and go to the US and see the unemployment rate at 5% and core inflation almost pushing 2, I would be surprised that the rates are at 50. But that is not the sole consideration. I mean, that is clear. That seems to be not the sole consideration. It's not the same regime as maybe 50 years ago when the Treasury Secretary famously said, the dollar is our currency and your problem. I don't think that is the approach that they have currently. So I think that is the big debate. I mean, does the Fed consider only the domestic monetary variables while setting policy, or do global considerations like China, emerging markets come into play as well? That is something we are waiting and watching. On the Brexit, I don't know. It's a binary event. Yeah. Very difficult to call binary events. But suffice to say that people are not going to deploy risk money in a hurry till these 2 events are out of the way.
Yeah, so I mean, that was the limited understanding I would have wanted, and thankfully both of you are not sounding too worried about it. What set the cat among the pigeons, Amay, just a brief thing on that, was also a couple of global events which people feared would derail the markets, which is both this Mauritius T3 or the P-notes issue. Somehow it doesn't seem to have done that for now. The markets have taken it up very sportingly after the announcements.
Well, I think many a times the reaction comes closer to the event date and not immediately on announcement. People are still trying to digest what it means, trying to figure out if there are alternative structures possible, if there are alternative geographies other than Mauritius which offer similar tax treaty benefits. So people are trying to work out different things. The government has been in dialogue with various investors. They've been giving clarifications. I think until a few days ago, people were not very clear whether this applies only to equity shares, or does this also apply to fixed income instruments, and does this apply to derivatives? So a lot of those clarifications have come through. Having said that, I don't rule out a possibility that the concerns increase as we approach the date of 1st April 2017, because often markets do wait for that actual date to come closer for a more adverse reaction.
So I think the only thing to add there is this time around the approach seems to have been different. The approach seems to have been to be open about it, give a timeline to it. Notice, yeah. There is a consultative process. It's not hidden within some fine print within the budget. That one day after the budget, the only discussion is about this rather than what other things were said in the budget. So I think that's a welcome departure from the way it was done in the past. We can debate about whether it's equitable, whether it's the right thing to do, etc. But we like that this is being done in a consultative way. There is enough time given to all stakeholders to view their opinions, and that's a forward step, I guess.
And it's also different from past episodes that we've had surrounding Mauritius. If you recall, in the last 10-15 years in the markets, there have been issues surrounding funds which have used the Mauritius route in the past as well. And that time there's been knee-jerk reaction in the market. And the difference between those past episodes and the current one is that in the past it was always some circular or some assessment order, or it used to be retrospective. So that caused a lot more upheaval. This time around, it's not retrospective, it's prospective. It's laid out in the tax treaty. The dates are very clearly given. The roadmap has been laid out. So I think that's, in that sense, if you're surprised that the market has not reacted in a similar fashion as it did in some of those past episodes, if you remember, where the reaction was far more extreme because it was all retrospective, it was unclear. This time, the roadmap is far more clear. The dates have been set. It's not retrospective. So I think that makes all the difference.
Timelines are 9 times what was usually given. Having said that, so if these are a couple of technical factors which could have caused problems, I think the fundamental factors seem to be okay. I mean, the reforms carriage, if at all, is moving even more swiftly with all that's happening in the assembly elections, rekindled hopes for GST in the monsoon session. And I read your note which speaks about, irrespective of what the IIP or some of the other data points are showing, there could be lead indicators which could be indicating otherwise as well.
We get reasonably high quality data in a fairly timely manner with some of these. And there are interesting trends that get put out from the dashboard that we see in front of us. Now, you have to bear in mind and you have to be conscious of the fact that just because some series is turning up or is looking up for a month or two does not mean that the trend is confirmed. You have to watch it, you have to talk about it, you have to speak, get lateral views, understand it from companies really. So the things that we are seeing which are looking up at the margin, or what we call inflecting, seem to be that at least the rural side of the economy looks to be a bit better.
Why do you say
as evidenced by tractor sales, been running negative for almost 24 months, just turning positive. Slight uptick in two-wheeler sales coming through. Again, as I said, difficult to call a trend straight away, but this is a big to-do WIP on our investing journals, investing books. So we are probing this, whether this is a durable trend. But the other thing I will caution about is that this is not just to do with monsoons. There is a tendency to make this one factor correlation between monsoon and rural health. If you go back to the last episodes of Broughton in about 5-6 years ago, tractor sales were at a new record in a drought year. So there are things which are not just rainfall dependent. There are many other things that go into what happens to the rural economy. We are probing this. This is looking very interesting. Another trend which we find is interesting is what we call internally as full airports and empty ports. If you look at the air traffic growth, passenger growth, it's running almost at 20%. And this trend has remained so for the past many months. But if you look at port traffic or exports growth, that's abysmal. I mean, it's close to zero. Exports are still registering negative growth numbers. So it's an interesting trend that we are seeing, that the airports seem to be full, but the ports seem to be empty.
So what's the inference, Amay?
No, I think the point we made for long is that the economic recovery this time around is going to be gradual and uneven. And I think the emphasis is on both words, gradual and uneven. So gradual does not mean that we're going to straight away see a 300 bip kind of improvement in GDP in a quarter or two. That's definitely not going to happen from the level. I'm not trying to quote levels because people go with the old series, new series, but I'm saying, will there be a significant immediate improvement in GDP? That's very unlikely. The reason so that's a gradual part.
Right.
On the uneven side, we are saying that the economic recovery, the inflection will happen in pockets, in different segments of the economy at different points of time. So like Swanand said, that there is an inflection apparently, yet to confirm, in tractor sales, for example. But does that mean that we can say a broad brush improvement in rural economy? May not be yet, right? So, so hence we need to realize that the economic recovery this time around is going to be uneven. It's going to be in pockets. You might see some segments outpace the others. Again, the airport-port analogy is very relevant here, where airport traffic may look extremely good, but that does not mean that port traffic looks good at the same time. It could have its own life cycle, and it could start trending at a different point of time. And I think that's what we need. So even within automobiles, you know, four-wheelers, two-wheelers, trucks, all showing a different trend, right? And all inflecting or turning at different points of time.
What are the spaces, because of these high-frequency indicators, that you believe could do well and are bullish on, and what are the pockets that you're bearish on?
The high-frequency indicators, we're clearly seeing improvements in electricity generation. We're seeing improvements in cement dispatches. Diesel consumption has held high. Tractor sales are seeing some turnaround. Two-wheeler sales and tractor sales, I would say, you know, you need to wait and confirm if there is a trend, because, you know, people are also trying to overlay the fact that you've had the first quarter, you know, you had some positives working in your favor, but now will that continue as, you know, in the second? So we need to wait and watch some of these confirmatory signals. But yeah, as we say, commercial vehicles, cement, diesel, electricity, these are showing a much stronger trend. Port traffic, export-import data continues to be weak. Rail cargo movement continues to be weak compared to road movement. So, so some of these trends are not yet showing improvement.
And where within these trends that are emerging are you placing bets?
So we would be looking at, let's say, cement companies. I mean, as I said, I mean, this looks like a trend which is done well. We are definitely exploring that space. The electricity generation growth, the more important facet of that is that the deficits or the demand, unmet demand that we had in the country has fallen to pretty much a multi-year low. So whatever the SEBs have been demanding in terms of power, I think the shortage is down to low single digits in terms of percentage points. That's a very important change. We talked about this phenomena for the past 5 years, and now that the problem seems to have been resolved with the SEB balance sheets now looking better, Uday bonds, etc., this big improvement seems to be largely ignored in the sense that there is now power availability situation today is much better than it was 3 years ago. What does it mean? Do you start looking at power generation capital goods companies? Do you start looking at utilities who will now have better PLFs, will generate better ROEs? Do you start looking at consumer durables because electricity availability is no longer an issue? So this is again a big chunk. I think it's a big change which is underappreciated. It's a big space that we are exploring to see if there are any changes which are happening here. SEB losses in the next 2-3 years might be a thing of the past for all you know, and that's a big change versus what we obsessed over in 2012 and 2013.
But I think one telling point that I want you guys to comment on is this earnings season. We talk about waiting for the print. I think the print this earnings season, compared to what the expectations were for a lot of people, has been fabulous. You've had more good reportings as opposed to negative surprises. What has stood out for you this earnings season? What space, what theme, what sector?
We've continued to see very strong trends in retail consumer lending. So banks and NBFCs in that space have continued to grow well. The microfinance segment has continued to grow well. So within the financial space, that has continued to report very good corporate earnings. In many of the other segments, you know, we've been positively surprised with the way media advertising has continued to do. That's been another strong trend, thanks, I guess, to e-commerce, to consumer companies having significant savings on the commodity side. So, you know, some of those trends have continued, and those trends, I think, are what we also picked up in our high-frequency dashboards.
A very interesting thing, though, this happened this quarter. I don't know if you guys think about it that it is as interesting, is the volume growth posted by those consumer companies which actually have the Ayurveda presence. I mean, everybody thought Patanjali coming in, that big gorilla, and actually, or an emerging gorilla, and it could disrupt the models. But somehow those are the companies, the Daburs, the Marigos and a few others which have actually done well this quarter.
Oh, I think it's a shift of consumer preference, I think, which is being manifested not only through Patanjali, which has been clocking numbers which are mind-boggling, but also some of the companies that you mentioned who in their specific portfolios which are more Ayurveda, herbal related, are doing much better. I think it's a lifestyle choice that everybody is making, and what I was surprised by, and this is again based on my personal interactions with people, is that this appeal is across SECs. It's not as if this is restricted only to the the masses as such, but this appeal for these products seems to be across income groups and social strata. So this seems like an interesting trend. The one thing I would say is a lot of the MNC consumer companies have been caught off guard with this. With the kind of MIS and the research that they have, if they could miss out a trend and a consumer need which was as significant, I think they really need to go back to the drawing boards.
Yeah, I confess I tried the Patanjali toothpaste. Not too bad.
But I think that's the key trend, right? A lot of us try to assume that as per capita incomes grow, every country will mimic what the West has done. But that does not mean, that's playing out very differently, I think, in countries like India and China, where very clearly with higher incomes, it does not mean that we are going to increase necessarily our consumption of carbonated drinks.
Yes.
It could very well mean that people spend more on, or the fact that people assume that as income levels go up, there'll be more ready-to-eat meals, that people would want to buy packaged food. But here, people may buy more fresh food. People may buy more herbal products, so it could be something very different.
Yeah, for all you know, the Parag milks and a few others 1% beverages could do well. However, and let's talk about an emerging trend, Amay, and that's the other note that you wrote about the ESG factors, social governance, all of that. Now, throw some highlight on that. What stood out for you as we start winding down this discussion? What stood out for you in terms of that study? What's the big inference of that study?
Well, I think there are two aspects. One is that environment, social and governance norms that institutional investors like ourselves are increasingly pursuing and reading about. What used to be in the corner of an annual report is now something that's coming more front page as far as our investment framework is concerned. So it's no longer something that you pay lip service to, right? In our meetings, in our interactions with management, in annual reports, we are trying to figure this out all the time. There are agencies that provide scores for us on ESG, and that becomes relevant in our investment framework. So this is the first aspect, that companies that score well on ESG will see more institutional investment interest versus those which don't score so well. It's almost like credit ratings. The second aspect is that ESG is also leading to some interesting investment themes. And pollution is the prime example, right? So while the odd and even rule in Delhi may make it to the headlines, the fact is that what is this doing to consumer behavior? What is this leading policymakers to do? And as a result, what interesting investment themes and trends are we seeing? And this becomes an important aspect as well. So two things. One is ESG scores and what it means for institutional interest. And two is what is ESG itself leading to in terms of more interesting investment themes.
Let's talk about the latter first, then we'll move on to the former as well, Swanand. What is ESG leading to in terms of investing themes within India?
So as a broad brush answer to this, we look at any solution or any product which is environmentally more friendly than the current product or service that's being used. A diesel car versus a gas, which is a CNG powered car. I think that's the easiest example to give. I think more and more people, just because of the economics of it, are going to likely shift towards CNG based cars. Not because there is a policy thrust, not because of anything else, but just it makes sheer economic sense to drive a vehicle which is on CNG rather than on diesel. And
so just to come in, just to clarify for our viewers, how would that impact your investment decisions? I mean, would you actually go out of a company which is primarily into diesel manufacturing as opposed to a company which is into that? I mean, I don't know of too many companies which are doing that too.
No, we wouldn't go out just because, so this is one factor which goes into investment decision, right? But even within, let's say, making a diesel engine, if there is a company which makes fuel injection very efficient, there is an efficient exhaust system, we would look at those companies which are into improving technology for fuel injection or for emissions. This is still a diesel engine, but it is better than the diesel engine was what it was maybe a couple of years ago. So it's a broad theme. People just tend to think that, oh, this is about some social, some pollution thing, but we are paying real serious attention to this. I don't know the last time I asked a CEO in a meeting, what do you do with your effluent? But these questions are being asked in meetings with CEOs, etc. So it's really mainstream now. There are investment opportunities. This is not some just compliance related issue, but there are investment themes around it, and more money is going to chase companies that score highly.
So what else, Amay, aside of this automobile example that he gave, what stood out? I mean, practically within the Indian context, what has been that investment indicator that is coming out of this process?
No, I think we've often seen that. So, for example, I'll give an example that cargo traffic has shifted from rail to road, and that's because the haulage charges in railway were taken up. Now, one could, I mean, it's quite obvious that it's far more pollution efficient to have cargo across the country move by rail. But you've seen a shift towards road over the last few years, and that's because of the pricing.
Right.
Similar is the case between the use of industrial use of gas versus liquid fuels, where again, because of the way the tax structure is, in some companies we see that there is a shift, and they're shifting towards liquid fuel as the price of crude oil has come down. So some of these behaviors can be changed through policy as well. The CNG example that he gave is pure economically led behavior change, but then you need to nudge.
Do you think that will happen though? And therefore, what's the takeout? I mean, if indeed haulage moves back to railways, I mean, does it impact CV sales? Does it impact toll traffic collection? What else? I mean, do you see that happening?
It impacts everything, yeah. And I think policymakers will increasingly give those nudges, through taxes, through odd even rule, through these kind of signals, you will see consistent nudges coming from policymakers as we've been signatories to these conventions on pollution and stuff, and we will have to comply with these. So you may see taxes on battery operated cars coming down. You may see a thrust towards solar power versus thermal power. So these things will continuously happen. This is an enduring trend. This is here to stay.
Okay, as we wind down this discussion, last couple of minutes, Swanand, as we find it out, as I understand, within your different portfolios and funds, your top theme, of course, are financials, private financials, and industrials. We got a flavor of the financials. What about industrials? Where within that large basket are you?
So within industrials is a very hold-all kind of a sector. It has capital goods, it has transportation, it has things like that. So the earlier theme which we talked about on your show is that the movement of goods in the country is something that may have taken a bit of a breather in the last 6 odd months, but it's a theme that we still stay positive on. Based on the ESG work that we have done, we are realigning the portfolio a bit towards more pollution efficient personal mobility, these kind of things. So movement of goods related stocks is what makes bulk of our industrials overweight. We are still not very positive on the private sector capex growth as we knew it in the past. That is not picking up in a big way. There are pockets of public sector capital expenditure which we find interesting. This is primarily roads, railways and things like that. So broadly that makes our positive stance on industrials.
Okay, and as we wrap up, I mean, you briefly mentioned 2-3 subsets within that private financial space. So are you completely overweight only on private sector banks, or MFIs or microfinance companies also form a part, home lending companies also form a part? Which within that pocket are you most bullish on?
No, I think there are several pockets within the retail consumer lending segment that have been doing extremely well. The microfinance, loan against property, mortgages, credit card, personal lending. So we are looking at companies in that it's in all these. But
that's a very wide basket. I'm sure there's a favorite.
Yeah, but the entire basket is growing 20%, right?
So you're bullish.
If you see the private sector and you see the consumer retail lending segment, even in the last quarter, almost every company has grown 20% plus in that segment. Then you look at each company and evaluate within their overall mix, how do these sub-segments stack up.
May the good times continue. But gentlemen, thank you so much for taking the time out and joining us in our studios with your opinion. That's the Morgan Stanley Investment Management view on the market. Not too perturbed with what's happening across the globe right now. If anything, might use those opportunities to increase their allocation to the preferred bets. Thanks so much for watching this show.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.